Hello, everybody, and welcome to Fast CPAs and Consultants. Here we are with our CPA, Fulton Abraham Sanchez. Hi, Fulton, how are you?
I'm doing fine, thank you.
Thank you. Well, this is a video series called Tax Talk, where we are going to talk about the different tax strategies that you must follow according to your situation, and we will answer the questions we have received through our social networks. You will find as well in the description of this video all our contact details. Today we will start talking about US expat taxes.
Yes.
Yes, it is quite a confusing topic, I think. For that reason, we chose it for being the first one. So, since we have received too many questions, we are going to divide this video into two parts. So for that reason, we are going to start right now with the first one. Are we ready, Fulton? So
yes, I am.
What we're going to do is I will ask you the questions we have been receiving, and you will explain us like in a really familiar way, like for mortal people, the answers of these questions.
Okay.
Okay, so here we go. The first one. We could say it would be the simplest one, but also the most important to know and be aware of. So, Fulton, do expats have to pay US taxes?
For expats, for US expats, the first consideration is that even though they live in a foreign country outside of the US, they still need to report to the IRS and to the US Treasury. They need to report to the IRS if they earn income either as a consultant, what is called self-employed, or as an employee, employed by a foreign company. Second, they also need to report to the US Treasury any holding of a foreign account with a balance of $10,000 or more. Those are the two main considerations that most of US expats do not have or do not know, that they still need to file income tax, and they have to report to the US Treasury their belongings, the balances of the account. In addition to that, there is the new tax reform in 2018 also requires that US expat having foreign companies, they have to report the profits of the company that they have in a foreign country to the IRS as well. And if some other expats have, for example, a trust, they need a foreign trust, they also need to report that trust to the IRS, even though there are no distributions. So in total, there are four considerations. The first one is report to the IRS your income, either income from payroll or income from self-employment. Second, report to the US Treasury your accounts in foreign banks with a balance of over $10,000. The penalty for not reporting that is $10,000 per account per year. So that's very stiff. Third, you need to report the profits of the company that you have in the foreign country. And fourth, you also, if you have a trust, a foreign trust in the foreign country, you need to report that as well. Those are the four main important things that an US expat need to know when is not living in the US.
Okay, thank you. I see. So yes, people who ask this question, they must really be aware of your answers, because there are four cases that Fulton already explained. Yeah. So now, if expats must pay taxes, how much tax do American expats pay?
The tax that the US expat typically pay depends on the level of income. For employees in foreign countries, when the US expats are employed in a foreign country and the foreign company pays taxes to the to the Social Security Administration of the foreign country, there is a foreign earned income exclusion of $110,000. It means that to avoid double taxation, the income that is earned by an expat in a foreign country and that income is under payroll, there is an exemption of $110,000. There is no tax for that amount. And we have seen cases like this. The problem with the foreign earnings income exclusion is that what happened is if an expat earns over $110,000, the portion over the $110,000 is taxed not at the beginning rate of 10%. It's taxed at the rate that corresponds to that level of income that it will be with the new rates between 22 and 25%. So you have to always remember that even though there is a foreign earned income exclusion of $110,000, whatever amount is earned over $110,000 is going to be taxable to the current rates at that portion of income, at that bracket of income. And that surprises many times to expats because they expect that because there is $110,000 in foreign earned income exclusion, that the portion over the $110,000 is not going to be taxable at the highest rate, but to the lowest rate. So that is, we have seen a couple of times that case that US expats were confused and they were expecting a lower tax bill and they got this tax bill higher than the one that luckily was compensating with taxes that they paid in the foreign country. That is only for a foreigner, for the foreign earned income exclusion. If you make $110,000 and you work, you receive payroll from a foreign company, then $110,000 and below, you pay no taxes. But if you receive self-employed income and there is no any dependent any relation of a working relation between a company and you work this by yourself, you will pay taxes. Maybe you will pay taxes in the country when you earn that income, but that income is also taxable in the US for the simple reason that when you retire, you will expect to claim taxes from the Social Security in the US. So because of that, the IRS expects that you report that income earned as a Social Security, as a self-employed, as a self-employed. The IRS expects that you report that income to the US and pay taxes in the US, minus any tax that you paid in the foreign country. That is the way how the IRS handles the taxes. What is the amount that a US expat pays? It all depends on the income. For the first case, as I explained before, over $110,000, any portion above $110,000 earned will be taxable at the current rate for that bracket, 22%, 25%. If there is more income, it's higher. For income that is self-employed, there are two kinds of taxes. The taxes for the income tax, that it goes by brackets, 10%, 12%, 22%, 25%, depending on the income, and the self-employment tax that is 15% flat. That 15% is what is known in the US as FICA. The FICA is Social Security and Medicare. That is a 15% that is taxable in the US for self-employed income, and is also taxable for foreign income received in a foreign country as a self-employed. Many people do not report that because the IRS has no way to know. There's no way for the IRS to know that you are working by yourself. There's no way. But remember, if you do not report and you plan to claim Social Security in the US, your claim of Social Security is going to be reduced, very reduced, because if you live in a foreign country, you are not, and you are working in a foreign country, you are not accumulating Social Security credits in the US. Therefore, as you do not accumulate Social Security credits, when you claim and you retire your Social Security, for those who are not retired yet, your claim, your payment is going to be very small because of the years that you have stayed outside of the US and not reporting Social Security. That is the predicament that many US expats have the moment that they report.
Okay, so IRS really, they do not make things easy at all.
No, IRS has no way to know that you are working as a self-employed if you work as a consultant, for example. But remember, if you are not retired, the IRS, you are not going to receive enough, or the amount that you receive on Social Security or from the Social Security is going to be very small.
Okay, got it. I mean, kind of got it, of course. It is really a complicated topic, of course. And then other question that I think, of course, you already answered is, do US citizens pay taxes when working abroad? Yes, of course. Yeah. You just said it.
Yeah. So I have seen cases, for example, that US citizens live in a foreign country, they have companies there, they receive dividends, they receive salary, and the combination of dividends, salary, and consulting income it goes beyond the $110,000, and they have to pay taxes. That is the problem. When your income is higher than $110,000 and you are an employee, you pay taxes minus the taxes that you have paid in your country. So you pay taxes in the foreign country. You have to take that as a credit now, and there is a point of caution there. Whenever you take taxes paid in the foreign country as a credit, and you have the foreign earned income exclusion, you only take the share of taxes that do not correspond to the $110,000 foreign earned income exclusion. A typical example, you made $150,000 in the foreign country. Just an example, $150,000. So you have and you pay $20,000 in taxes, just a number. So out of the $110,000 that you received, $150,000 that you received, $110,000 is a foreign earned income exclusion. But when you are going to report the taxes from the foreign country, you cannot claim that you have paid taxes for $50,000, because part of those $50,000 corresponds to the $110,000 foreign earned income exclusions. And this, I've seen this when returns come from different CPAs. I've seen this over-reporting of taxes. Whenever I have $150,000 I made in the country that I'm living, and I paid $50,000 in taxes, I cannot say that I have paid $50,000 of taxes, because the IRS is giving me a break of $110,000 in my income. So I have to do a pro rata. What is the corresponding of the 50,000 to the 110, and only claim the portion that is not corresponding to the 110. So I cannot claim $50,000 because I already have a break from the IRS. I can probably claim only out of the 15,000, because I have a portion of $110,000 that is non-taxable. So I cannot claim a foreign tax credit for all of the $50,000 that I paid in the foreign country, because it's not true. The IRS is giving me, in the US, the IRS is giving me a break for $110,000. So I cannot claim $50,000 that I paid in taxes in the foreign country as a foreign income credit. I have to claim only the portion, the pro rata of the 50,000 related to the 110 of the foreign earned income exclusion. This is something that is not clear. I've seen many questions about this, and we always play safe. We always play safe. And I know sometimes this creates a problem for expats reporting because they say, I pay $50,000 of taxes in the foreign country. Why I cannot claim the 50,000 as a foreign income, as a foreign tax credit? And the answer is very simple. You cannot claim $50,000 paid in the foreign country because the IRS is giving you a break over $110,000 of foreign earned income exclusion. So as you exclude the income for $110,000, you have to exclude also the portion of the taxes that you paid in the foreign country. It's a complicated topic.
Yes.
But believe me, I've seen this in return. So keep in mind that even though you pay taxes in the foreign country, unless you are self-employed, they are 100% deductible. If you are not self-employed and you work for a company, the taxes that you paid in the foreign country are not fully deductible because you have a foreign earned income exclusion. It's complicated, but if anyone with questions, it's free to email us, and we will be more than happy to provide this guidance, because it's good that expats know this, that it's not nice to have these surprises at the end of the year. I've seen clients, they have these surprises at the end of the year because in the previous reports, other accountants, they have claimed the full taxation. They don't have any problem, any immediate problem. Problem is that if the IRS selects your return for an audit, that's when the problems start. Although there is a statute of limitation of 3 years that the IRS can only audit you 3 years back without counting the year that we are at. So without counting the year we are at, the IRS can audit you 3 years back. If your return is selected for an audit, it's going to be necessary for you to prove of your claim. So it's better to play safe instead of creating all these gimmicks that at the end it's not gonna be productive. It's not gonna be worthy to go that route.
Of course, it will be a nightmare instead.
Yes.
Yeah, there are so many details, and so these kind of small letters that you should be really aware. If not, you will have some trouble with the IRS.
Correct.
Oh, okay. So, we continue. So another question that we have received is, do US citizens living abroad get a stimulus check?
Oh, yes. Yeah.
So there is a good news.
I have in this tax season, I had 2 or 3 people who email me, how do I get my stimulus check? This current check, for example, she was asking, how do I get my stimulus check? I missed the previous one because we are by the 3rd stimulus check. So many people have received 1, 2, many people have received none. I say the only way to claim your stimulus check, if you have not received any stimulus check before, the only way to claim a stimulus check now is to file a tax return and pay at least $1 of taxes. Because when we are filing tax return, there is a field, 2 fields saying how much you receive in your stimulus check. If the client didn't receive any, we put 0 and 0, and the IRS is going to send you or deposit you the checks, or deposit you the stimulus checks in your account. I am assuming that for this 3rd round of stimulus, the IRS is going to enable a website, because I know that happened with the first check, the first and second. The IRS enabled a website for people not filing taxes. For US citizens not filing taxes, the IRS enabled a website where you can update your information. But so far, if we are in tax season and there is a stimulus check, the best way to claim is to file a tax return, but you need to at least pay $1 of taxes. The IRS will not accept a 0 return. I think that once we did for a tax return for $1. So client had to pay $1 tax. It happens, and it works. But yes, they receive the stimulus check. Now, some US expats who do not have a bank account when they file taxes, the checks get physically to the country. That works in Europe where mailing systems are as good as in the US. But for Latin America or for Middle East or for Africa, um, it's not gonna be easy to get a check there. Just to give you an example, we have a case for a client. The check went to the embassy in the country, and then from the embassy to the consulate, and then from the consulate to the client. So it was months that when the client got that, because there was no a bank account in the return. The client preferred not to provide bank account information. That's one. And second is because the address is not in the U.S. If the address is in the U.S., then the check goes to the U.S. address, and then someone can send the check to the person or deposit it in the bank account. But if there is no U.S. address in the return, then the stimulus checks are not going to get in the U.S. So there are two things. One is the bank account. That is the easiest way to get the money, is having a bank account in your tax return. And second, if you don't have a bank account, at least have an address in the U.S. so someone will be able to deposit your check in your account.
Okay, okay, got it. So after knowing all this information you have to give us, and for instance, I am an expat and I do not want to pay taxes. How can I avoid paying US taxes abroad? I mean, is there a legal way?
The easiest way for not paying taxes as an expat, a US expat, is working for a company, being under payroll. The company contributes to the Social Security in the country, and earning less than $110,000. That is the key. Remember, if you do not work as an employee and you work by yourself, that you cannot avoid paying taxes in the U.S. because the USA has this system of taxable. The income is taxable, worldwide taxable income. So the income that is earned by the U.S. citizen or the U.S. resident from any source is taxable. Personally, is taxable, either domestic or foreign income.
Okay. Okay, there is another situation that people asked us. For example, if I am a US citizen and a Mexican one at the same time, but I do live in Mexico. So I guess I will have to pay taxes only in Mexico, won't I? Or do dual citizens pay taxes in both countries of residence?
It all depends. It all depends if you work by employee by a company. If you work employed by a company, and that company contributes to the Social Security in Mexico, you earn less than $110,000. That is the foreign earned income exclusion. Then you pay taxes only in Mexico.
Okay,
You don't need to file. You don't need to file in the U.S. if you are under that. Now, it will be good for you to file in the U.S. because there is all these checks that are coming, and you will benefit from that stimulus that the U.S. is giving to its citizens.
Okay, okay, got it. So if after everything that Fast CPA and consultants has told me, I still do not want to pay taxes, what happens if I don't file taxes while living abroad?
If you do not file taxes, and because you didn't know that you have to that you have to file. There is a program that is called the Streamline Program by the IRS that requires the filing of the last 3 years of taxes. And if there is any income, to pay penalties, to pay interest, and the last 6 years of foreign bank accounts report to the US Treasury. With that, 3 years of taxes, back of taxes, last 3 years of taxes filed and paid, and last 6 years of foreign bank accounts reported, the IRS will give you, the IRS will bring you to order, meaning that you will satisfy all the requirements of filing, all the requirements of filing with the IRS after paying taxes, of course, and you will be fine. We've seen cases that because of expat work in the foreign country, they want to file tax order with the IRS. They don't pay. They file tax return. They report to the U.S. Treasury, what is called FBAR, or the bank accounts over $10,000, and they pay no taxes because they work as employees, and they come to order with the IRS. They are in order with the IRS, meaning they have all their filings obligations with the IRS. Okay.
Okay, I see. And since we're running out of time, we have here the last but not the least question of this video. How does IRS know about foreign income? I mean, if I earn money in Mexico, IRS shouldn't be aware of it, right?
Well, yes and no. The IRS has signed agreements with all the banks in Latin America. All of them. There is no exceptions. For the simple reason that all Latin American banks need corresponding accounts with banks in the USA. So that's how the IRS got all these Latin American banks. And this is for the entire world. It's not only Latin America. It's African banks, European banks, Australian banks, Asian banks. This is around the world. This is how the IRS created this control, and it's called FATCA, F-A-T-C-A. This is the FATCA. The FATCA requires that all banks report to the IRS any account with any balance that a U.S. citizen holds in a foreign bank, in any foreign bank. That's how the IRS, and this is the IRS directly, this is not the U.S. Treasury. The IRS directly knows who holds money outside of the U.S. and in what amount. Otherwise, the IRS will force to the U.S. banks to cancel the corresponding accounts for these banks in the foreign country. This is how the IRS know who holds money outside of the U.S., who is who in holding the money. And this is how all these accounts in Switzerland came to know to the IRS, and they discover all these people holding all these balances, and they bring them in, and they charge them criminally, and they impose these steep penalties up to 120% of the amounts that they have holding in those accounts. So this is how they know, because the IRS created this FATCA thing, and this FATCA has made all banks outside of the US liable for information of holdings for US citizens when they open accounts in the foreign country. That's how the IRS know. Obviously, if you have a balance of $80,000 in the foreign country and you report zero in the US, the IRS is gonna know. And if the next year the balance grows to 200 and you report zero in the US, the IRS is gonna know. For sure, they're gonna know. There is no, perhaps because we are still in pandemic, there is no the intention to go after all this fraudulence, this fraud yet. But at one point it's going to happen when the system get better, when things get better in the USA and in the world, then this is going to come to an end, and then everyone will have to be brought to to account.
Wow. Well, really, really complicated, but really detailed information. And yes, we are done for this video. Thank you very much, Fulton, for this, all this information. Of course, it is not easy at all, but yes, we need to be aware of all this information. So thank you, everybody, for being with us here. Remember that we are going to answer more questions about expats in the second part of this video. So invite you to subscribe to the channel, since you are going to receive really vital information that can save you a lot of problems and money, since Fulton already said a little bit about it. So you can also leave us your questions in the comments or write to support@fastcpasconsultants.com. You also have our contact details in the description of this video and below. So thank you very much again, and see you in the next video. Thank you, Fulton, again. See you.
Thank you.